Ever wonder how to spot when a stock is about to reverse its trend, either up or down? Today, we'll demystify the Relative Strength Index, or RSI, a powerful momentum oscillator. We'll cover its basics, calculation, interpretation, and how to use it in your trading strategies. The RSI is a technical analysis indicator that measures the speed and change of price movements. It helps evaluate overbought or oversold conditions in an asset's price. The RSI oscillates between 0 and 100, providing clear signals. Here's how it typically appears below a stock chart, showing its fluctuating line at its core. RSI compares the average gains during up periods to the average losses during down periods. This is typically calculated over a 14-period time frame, though it can be adjusted. First, we calculate relative strength, or RS, which is the ratio of average gains to average losses. Then, the final RSI formula smooths this value, ensuring it stays within the 0 to 100 range. Understanding this calculation helps you appreciate the indicator's underlying logic. Now, let's interpret RSI signals. Levels above 70 typically indicate an overbought condition. This suggests the asset might be overvalued and due for a potential downward reversal. Conversely, an RSI below 30 signals an oversold condition. The asset could be undervalued and poised for a potential upward reversal. Divergence is another powerful signal. Bullish divergence occurs when price makes a lower low, but the RSI makes a higher low, hinting at an upcoming upward reversal. Bearish divergence is the opposite. Price makes a higher high, yet the RSI makes a lower high, suggesting a potential downward reversal. These divergences are powerful indicators of trend weakness or strength. RSI can confirm other signals, like support and resistance levels or candlestick patterns. Traders often use overbought, oversold signals for entry or exit points. Combining RSI with trend indicators can enhance your trend-following strategies. However, remember that RSI is not foolproof. It should always be used with other tools. In summary, RSI is a versatile momentum oscillator for identifying overbought and oversold conditions. It helps spot potential reversals and confirms other technical analysis signals. Practice using RSI, combine it with other indicators, and refine your trading approach. Mastering RSI can significantly enhance your market analysis.